Good afternoon. This is just an update for everybody. I know the market was down a lot this morning. It's down a little bit less than it was. There's a lot of talk that the war is going to go on longer, and certainly Iran is not Venezuela. They're fighting back a little bit, and people are contemplating that it'll be a longer than shorter war. Anyway, as you guys know, the United States and Israel hit Iran over the weekend. Oil spiked, stocks dropped at the open, and then they recovered surprisingly yesterday. Defense stocks, they jumped up higher, as you would imagine, and gold broke above 5,300. It's a lot of noise, a lot of fear, but one of the sharpest macro strategists on the planet, our favorite guru, Dr. Ed Yardeni, Dr. Ed we call him, he just published a research note that cuts through all of it. His title is Sweet and Sour, and that's exactly what we're dealing with right now. A mix of good news and bad news for the portfolio, but only in the short term. None of this is bad news long term, as long as you have a plan and as long as you guys have enough cash to get through a downturn. Today, I'm going to just walk you through Yardeni's latest research piece. We give full credit to Ed and his co-author, Toby Hurst, and telling you what it means for your retirement savings. Ed Yardeni has been one of our go-to macro researchers for over 35 years. When Yardeni publishes, we pay attention, and so let's get into it. Yardeni and Hurst open their note by saying they remain in the short war camp, and that's where we are too, at least for the time being. It's not going to be as short as Venezuela. It'll be a shorter rather than longer war. Right now, the Poly Market, which is the odds maker website, has the odds rising that this will be a war that will be less good. We believe that conflict will be limited and not drawn out. The stock market on Monday seemed to agree. The S&P 500 was basically flat yesterday after an early dip of more than 1%. Defense stocks rose sharply, and that tracks with what you'd expect when military operations begin. Yardeni makes a broader point, though. Historically, geopolitical crises have created buying opportunities in the stock market, going way back to the Smoot-Hawley Tariff in 1930, through Pearl Harbor, through the Cuban Missile Crisis, 9/11, and Russia's invasion of Ukraine. The market recovered every single time. And if you guys have been listening to me, you know that the market always recovers in the long term. Anyway, the catch Yardeni flags, everyone knows that pattern by now. The magnitude of the dip and the opportunity shrinks every time. Iran has activated an interim leadership council after losing its supreme leader. Losing is a euphemism for being killed. Yardeni notes that Iran's foreign minister admitted soldiers in the field have no command structure. They're following the last orders received before the top commanders died. That signals disorganization and not escalation. Yardeni connects the Iran situation to something even bigger. China, and so do we. America's recent military actions in Latin America and Iran are designed to check China's ambitions. China imports large amounts of oil from Venezuela and Iran and has invested heavily in both countries. Yardeni's read, a stable Middle East lets the United States shift more military resources to the Pacific, and that makes a Taiwan invasion harder for Beijing. So for a retirement investor like us, it all matters. A short war followed by a more stable region is unbelievably bullish. A wider war dragging China in is a different scenario, but right now, Yardeni, the market, and we are betting on the first one. Now for the sweet spot. U.S. manufacturing is showing some real signs of life. The ISM Manufacturing PMI, which is the Purchasing Managers Index, came in at 52.4% for February, following 52.6% in January. Any reading above 50 signals expansion. After a long stretch weakness, this is a meaningful change. New orders, a leading indicator, hit 55.8, production reached 53.5, and factory floors are getting busier. Great news. There is a soft spot in the reports. Employment's at 48.8, still below the 50. And factories are producing more, but haven't fully ramped up hiring yet. So for someone building a retirement portfolio around ownership of great businesses, a manufacturing recovery broadens the earnings base beyond tech, and of course, that's healthy. Now, the sour part. January's producer price index came in hotter than expected. Core PPI hit 3.6% year over year. Month over month was 0.8%, almost triple the 0.3% forecast. Headline PPI printed at 2.9%. Yardeni and Hearst point out both measures have stopped declining. They've moved sideways, and the disinflation that we've had, meaning the rate at which prices are falling, has looked like it's stalled. It's not going up, but it's also not going down. Most of the stickiness lives in services inflation, like supercore readings, they call it. Services minus energy and housing are stuck in the low to mid 3% range. So Jenny's view is that productivity gains should keep unit labor costs in check, gradually easing services inflation. And once Iran ends or gets close to ending, he expects oil prices to fall, bringing headline numbers down. But the Fed is watching, of course. PPI makes rate cuts less likely in the near term. So that's the picture from Yardeni and Hearst this week. Sweet and sour. Manufacturing is recovering, and that's real. Inflation is stickier than expected. That's real too. The Iran conflict, while serious, looks like a short duration event. Markets are already pricing in. And the biggest takeaway from 35 years of following Yardeni is geopolitical fear makes people sell. History says that's usually the wrong move. The right move is to own shares of great businesses with management teams that think like owners, companies that compound through the crises and not because of them. If this breakdown helps you understand what's happening with Iran, inflation, and your portfolio, you're going to want to see this video here where I break down how we build portfolios designed to hold through exactly these kind of events. Hey, and if you want a free review of your 401k choices to see whether your current lineup can handle what's coming, click the link in the below description or the pinned comment below. Thanks.